Hey everyone, welcome back. Today we're going to do a deep dive, and it's going to be all about uncovering some potentially awesome dividend stocks. For 2025, we're going on a treasure hunt of sorts, using an article from The Motley Fool as our map.
Oh, nice.
So, you want to get a solid grasp on why these companies are considered top picks for generating that passive income stream we all dream about, and we're here to help you do just that.
All right, sounds good. Yeah. The Motley Fool, a respected name in financial services, they've handpicked these companies. And we're going to break down exactly why they think these stocks are poised to deliver those gifts that keep on giving, as they put it.
I love that. Gifts that keep on giving. All right, so first up is a company practically everyone knows, Coca-Cola. I mean, seriously, is there anyone who hasn't seen that iconic red logo?
Right. It's true. Coca-Cola, they're a global powerhouse, but beyond, just the brand recognition, they've earned the title Dividend King, and that's with a remarkable 62 years of consecutive annual dividend increases. That's commitment.
Wow, that's impressive.
Yeah. And their current yield is over 3%, which blows the S&P 500 average of 1.2% right out of the water.
Okay, that's impressive, but the beverage market is constantly evolving, right? Can Coca-Cola really keep this growth going with all the new trends and all this competition popping up? Like, what are some potential hurdles they might face?
That's a great question. It's true. The beverage industry is considered mature, so, it's not expected to grow as explosively as, say, the tech sector, right?
Yeah.
But Coca-Cola, they have a few tricks up their sleeve. Remember that wide moat the article mentioned?
Yes.
That means it's incredibly tough for competitors like Pepsi to seriously challenge their market dominance. Plus, they're strategically expanding into new beverage categories like plant-based drinks to capture those evolving consumer preferences.
So they're not just resting on their laurels, they're adapting and innovating. That's reassuring. But what about their projected growth in terms of cold, hard cash? The Motley Fool mentions a 4% to 6% organic revenue growth, which, if I'm being honest, sounds a bit like financial gibberish to me. Can you translate that into plain English?
Absolutely. Organic revenue growth just refers to the growth coming from their existing businesses, not from buying other companies. It's like measuring how much their core operations are thriving, and in Coca-Cola's case, they're predicting solid growth there.
So they're expecting their main business to do really well, which hopefully means more money to share with us investors through those dividends. But how does that growth actually translate into bigger dividend payouts? What's the connection there?
That's where earnings per share, or EPS, comes in. Coca-Cola projects their organic revenue growth could lead to a 7% to 9% annual increase in EPS. Basically, they're saying they'll be making more money per share, and that fuels their ability to keep increasing those dividend payouts to investors. It's like a virtuous cycle of growth and rewards.
That's the kind of cycle I like to hear. Okay, let's shift gears and take a look at our next contender, Johnson & Johnson. They're described as a financial fortress, which makes me think they're sitting on a Scrooge McDuck-sized pile of cash.
Well, they do have a stellar credit rating and a whopping $20 billion in cash on hand, even after spending $18 billion on acquisitions last year.
Whoa.
They also maintain a relatively low net debt of $16 billion. That's a sign of a company that knows how to manage its money.
They spent $18 billion and still have $20 billion left over. That's insane. But acquisitions can be risky, right? Couldn't Johnson & Johnson's, heavy reliance on buying other companies become a problem down the road?
That's a valid concern for sure. It's essential to look at the strategy behind those acquisitions. For Johnson & Johnson, it's about bolstering their medical technology capabilities and expanding their pipeline of new medicines. They're actively strengthening their core businesses and fostering innovation, which is crucial for long-term growth.
So it's not just random spending sprees. There's a method to their madness. And they're not slouches when it comes to rewarding investors either, right?
Absolutely. Like Coca-Cola, Johnson & Johnson boasts a 62-year history of consecutive dividend increases, earning their own Dividend King crown. Plus, their current dividend yield is almost 3.5%.
Even better than Coke.
Yeah, even better than Coca-Cola.
Wow, these companies are really duking it out for that dividend throne. But hold on, you mentioned free cash flow. Can you explain what that is and why it matters to us dividend-hungry investors?
Sure. Free cash flow is essentially the cash a company has left over after paying for its essential operations and investments. Think of it as the company's fun money,
Yeah.
Johnson & Johnson boasts a robust free cash flow of $14 billion, which is more than enough to cover their $8.8 billion dividend payout. It signals they have, financial wiggle room to keep those dividends flowing and potentially even increase them in the future.
Okay, so we've got two titans of industry here, both with impressive track records and healthy financials. But let's turn our attention to a company that's playing in a different arena. NextEra Energy. What makes them stand out in the world of dividend stocks?
So NextEra Energy brings a solid 30-year history of dividend growth to the table. What's remarkable is their 10% compound annual growth rate over the last 20 years. That's some serious dividend appreciation.
A 10% growth rate. That's incredible. Their current yield is around 3%, similar to Coca-Cola. But what about the future? Can they keep up this impressive pace?
That's the million-dollar question, isn't it? Well, NextEra Energy projects, they'll maintain that 10% annual dividend growth rate through at least 2026. They're not shy about their ambitions.
That's a bold statement, but what makes them think they can pull that off? What's the secret sauce behind their projected growth?
Their secret weapon, renewable energy.
Oh, okay.
They're banking on the growing demand for cleaner, more sustainable energy sources. And they're investing heavily in expanding their renewable energy infrastructure.
Renewable energy is definitely a hot topic these days.
Yeah.
But is it enough to support that kind of growth? How big of a bet are they making on this trend?
It's a massive bet, but they seem confident they can win. NextEra Energy anticipates a significant increase in demand for renewable energy and storage capacity, driven by factors like, climate change concerns, falling renewable energy costs, and the increasing need for power from sources like AI data centers. By 2027, they expect to more than double their renewable energy and storage capacity to a whopping 81 GW.
Wow, they're really going all in on renewable energy. But talk is cheap. Can they back up their ambitious projections with solid financials?
That's where their conservative financial approach and robust growth prospects come in. NextEra Energy projects a 6% to 8% annual earnings per share growth through 2027, primarily driven by their massive renewable energy project backlog.
So they're not just riding the renewable energy wave, they're strategically positioning themselves as leaders in this rapidly expanding market. That's a compelling story, but I'm curious, how does their projected growth compare to Coca-Cola and Johnson & Johnson?
That's a great question to consider. We've covered a lot of ground with these three potential dividend dynamos, and it's a lot to process. Let's take a moment to recap what we've learned so far, before we dive deeper into the factors you should consider before making any investment decisions.
Sounds like a plan. We've got Coca-Cola, the global beverage giant, Johnson & Johnson, the healthcare and consumer goods powerhouse, and NextEra Energy, the ambitious champion of renewable energy. Each company is bringing its A game to the dividend table, but which one will be the ultimate winner for your portfolio? Stay tuned to find out. Welcome back. We've got our three dividend contenders, Coca-Cola, Johnson & Johnson, and NextEra Energy. They all seem promising, but like any good detective, we need to dig deeper before we make any decisions about adding them to your portfolio.
Exactly. It's tempting to get swept up in the excitement of potential dividends, but remember, informed investing is a journey, not a sprint. We need to assess each company carefully, considering factors beyond just those tempting yields.
All right, let's put on our detective hats and examine the clues. First up, valuation. How do we know if a stock is a good deal or if we're paying too much? I'll admit, this part always makes my head spin a little.
Yeah, it can be a bit confusing, but one helpful tool is the price-to-earnings ratio, or PE ratio for short. It compares a company's stock price to its earnings per share. A high PE ratio could be a red flag, suggesting the stock might be overvalued. We also want to look at the dividend payout ratio, which tells us what percentage of earnings is being paid out as dividends. A very high payout ratio could be a sign that the company might struggle to maintain its dividend if their earnings take a hit.
Okay, so PE ratio and dividend payout ratio are on our checklist. What other clues should we be looking for?
Industry outlook is crucial. We want companies riding the wave of future growth, not clinging to shrinking markets. NextEra Energy, with their focus on renewable energy, seems well positioned for a bright future, wouldn't you say?
Definitely. But what about Coca-Cola and Johnson & Johnson? What's the long-term forecast for their industries?
Well, the beverage market, where Coca-Cola reigns supreme, is considered pretty mature. It's not going to see the explosive growth of some other sectors. However, remember that wide moat we talked about? Coca-Cola's brand power and global reach give them a significant edge over competitors. Plus, their move into new categories like plant-based drinks shows they're adapting to evolving tastes.
So they're not just sitting back sipping on their sodas, they're actively looking for ways to grow. What about Johnson & Johnson? They're in the healthcare and consumer goods space, right?
Exactly. And the healthcare industry especially is projected to grow steadily due to factors like an aging population and the ever-increasing demand for innovative medical technologies and treatments. Johnson & Johnson, with its strong R&D and diverse product portfolio, is poised to capitalize on this growth.
It sounds like all three companies have some solid tailwinds behind them. But what about those unpredictable storms? Companies can face unexpected challenges, industries can shift. How do we assess a company's ability to weather those inevitable storms?
That's where competitive advantages come in. Think of it as a company's secret weapon, something that sets them apart and helps them thrive even when things get tough. So Coca-Cola has their iconic brand and unparalleled distribution network. Johnson & Johnson boasts vast research and development capabilities and a diverse portfolio of products. And NextEra Energy benefits from their scale, their regulated utility business providing stable income, and their expertise in the booming renewable energy sector.
So it's not just about looking at the numbers, it's about understanding what makes these companies tick, what makes them resilient in the face of challenges. But even with the best strategy, a company's only as good as the people steering the ship. Right?
Absolutely. Management quality is a critical factor. We want companies led by experienced, capable leaders who make smart decisions and prioritize shareholder value. You can research a company's management team, look at their track record, their strategies, to get a feel for their leadership style.
That makes a lot of sense. After all, even with the best car, if you have a terrible driver, you're likely headed for a crash. Speaking of crashes, how do we mitigate the risk of our investments going south? No one can predict the future, right?
You're absolutely right. No one has a crystal ball. That's why diversification is essential. You know the saying, don't put all your eggs in one basket.
Yeah.
Instead, think of your portfolio like a delicious pizza with a variety of toppings. You want different flavors to create a balanced and satisfying experience. Spreading your investments across different companies, industries, and asset classes helps minimize your exposure to any single investment's potential downside.
So we've got our checklist: valuation, industry outlook, competitive advantages, and management quality. And we always keep diversification in mind to spread the risk. But all of the information is great. It really is. But how much can we trust the Motley Fool's recommendation? I mean, they're not always right, are they? Do they have a good track record with their picks?
That's a valid question. While the Motley Fool has a good reputation and a lot of experience in the investing world, remember, no one can predict the future with a 100% certainty. The stock market is a complex beast influenced by countless factors.
So it's like they're giving us a treasure map, but we still need to use our own judgment and navigate the terrain carefully. We can't just blindly follow their directions and expect to strike gold every time.
Exactly. It's about empowering yourself to make informed decisions, not blindly following anyone's advice, even from experts. Take their recommendations as a starting point, do your own due diligence, and see if their picks align with your personal investment goals and risk tolerance.
Speaking of risk tolerance, that's something we haven't really touched on yet. How do we know what level of risk is right for us? Is there a one-size-fits-all answer?
Not at all. Risk tolerance is deeply personal and depends on various factors like your age, financial situation, and comfort level with market fluctuations. Some investors are thrill seekers, comfortable with higher risk investments that could potentially yield bigger returns, while others prefer a smoother ride, even if it means slightly lower returns.
I tend to be more on the cautious side. Slow and steady wins the race, right? I like to know my investments are relatively safe, even if it means potentially missing out on some of those explosive growth opportunities.
And that's perfectly fine. There's no right or wrong approach. It's about finding what aligns with your personal comfort level and financial goals.
Okay, so we've talked about risk tolerance, diversification, and the importance of doing our own research, even when using reputable sources like the Motley Fool. We've dissected the financials, analyzed the industries, and even gotten a glimpse into the minds of the people running these companies. But ultimately, the decision of whether to invest in any of these dividend stocks is up to you, our listener.
We've given you the tools and insights to start your own exploration, but the power to make informed decisions is in your hands. It's your money, your future.
We've covered a lot of ground in this deep dive, haven't we? We've explored Coca-Cola, Johnson & Johnson, and NextEra Energy, delved into their strengths, their growth prospects, and those tempting dividend yields.
We've also emphasized the importance of approaching any investment decision with a critical eye, understanding valuation, industry outlook, competitive advantages, management quality, and the ever-present need for diversification.
Absolutely.
We've also highlighted that investing is a journey, not a sprint. It's about making informed decisions that align with your long-term financial goals and risk tolerance. And remember, there is always more to learn.
Well said. We've given you the tools and insights to start your own exploration of these companies and the world of dividend investing. Now it's up to you to dig deeper, ask questions, and make informed decisions that feel right for you. We've done our part. Now it's time for you to do yours. But don't worry, we're not leaving you hanging just yet. We'll be back for the final part of this deep dive to wrap up our discussion and leave you with some final food for thought. Until then, happy investing. All right, welcome back to the final part of our dividend deep dive. We've gone through Coca-Cola, Johnson & Johnson, and NextEra Energy, really analyzing, their strengths, their financials, and their potential to deliver those passive income streams we all love.
Yeah, and I think, we've really emphasized the importance of looking beyond just the dividend yields,
Yeah,
considering those factors like valuation, industry outlook, competitive advantages, management quality.
absolutely. We've even donned our detective hats. We learned how to assess risk, diversify those portfolios, and make those informed investment decisions. But before we send you off on your own investing adventures, we want to leave you with one final thought to ponder.
Yeah, it's so easy to get caught up in the numbers game of investing, focusing just on those, potential returns and financial gains. But investing is about more than just building wealth, right? It's about using that wealth to create a life that aligns with your values and aspirations.
Yeah, think about it like this. Imagine you've achieved your financial goals. You've got that comfortable nest egg, that financial freedom you've been working towards. What's next? What does that freedom allow you to do?
Maybe you've always dreamed of traveling the world, exploring new cultures and experiencing, all that life has to offer. Or perhaps you're passionate about starting your own business or pursuing a creative endeavor or, even giving back to your community.
Right. Maybe you simply want that peace of mind, knowing you can support your family, pursue your hobbies, and just enjoy life without constantly worrying about money. Whatever your vision is, your investments can be a powerful tool to help you turn that vision into a reality.
So true. So as you consider these dividend stocks or any other investment opportunity, ask yourself this question: How will this investment help me live a more fulfilling life?
Will it bring you closer to those travel dreams? Will it fuel your entrepreneurial spirit? Will it give you the financial security to pursue your passions without hesitation?
Yeah, investing isn't just about those numbers on a spreadsheet. It's about aligning your financial decisions with your values, your goals, and your vision for the future.
That's such an important reminder. It's easy to lose sight of the bigger picture when we're so caught up in analyzing those PE ratios and dividend yields. But ultimately, investing should be about more than just maximizing returns. It should be about creating a life that is meaningful and fulfilling.
Absolutely. We hope this deep dive has equipped you with the knowledge and inspiration to embark on your own investing journey. A journey that's not just about financial gains, but about building a life that truly reflects your values and aspirations.
Yeah, thank you for joining us on this exploration of dividend stocks and really the deeper meaning of investing. Remember, knowledge is power, and informed investors are empowered investors. Now go out there, do your research, make those informed decisions, and most importantly, invest in a future that brings you joy, purpose, and fulfillment.
Happy investing, everyone.